Hi everyone, I'm Andrew with Jesani Wealth Management, and we know that interest rates can not only have a dramatic effect on the overall economy, but it really trickles down to individual consumers and businesses, big and small, because of the cost that you will pay to borrow money to do whatever it is that you want to do, whether it's to buy a home or to buy a car or invest in your workforce or invest in a new business. When money's more expensive, of course, it's more difficult to do that. So some of the rates that are tied to a lot of financial products out there, of course, you have the federal funds rate, which I'll discuss in a moment, but also LIBOR, which has officially now in 2022 been replaced by SOFR, and of course, prime rate, which I'm sure you've heard of particularly when you're talking about mortgage loans. But the federal funds rate is probably what you hear about most often when you hear on the news that the Fed raised rates a half a point today, or most recently 75 basis points. What that is, that's the Federal Reserve meeting, which they do about every 6 weeks. And they're looking at all economic data available, but with really a focus on two key pieces. One being inflation, which they like to see at around 2%. That's where it should be. And then two, the labor market and the unemployment rates. Really based off of those two, they will make a decision to either raise rates, lower rates, or keep them the same. So probably the easiest to discuss the scenario now where we have really high inflation. The economy is a little bit too heated up. So what the Fed has done is they've raised interest rates to make money less accessible to the economy and slow down economic growth. Where let's say that the inflation was low, the unemployment was at 9%. What they would do is lower rates to make it more easy for businesses and consumers to borrow money, which they can then turn around and invest in their business, invest in their employees, or increase their salaries, or put into R&D, or add more jobs to the market. So that's really the number one tool that the Fed has to kind of leverage the economy in the direction that it needs to go to continue stability. They can also sell federal bonds into the consumer markets. So when they do that, the markets are buying the bonds, thus lowering the money supply, which in turn will raise rates. On the contrary, they can buy back federal securities. The Federal Reserve can buy them back, which is going to push a lot of cash out into the market, which will loosen up rates, make it more easy to borrow, and therefore lower the cost of borrowing. So that's really what the federal funds rate is. But tied to that, you have LIBOR, SOFR, and prime rate, which is what a lot of financial products and a lot of the major banks use to determine what rate they're going to charge. So let me just pull up a chart that shows a few of the different rates here. Here's the Federal Reserve rate, by the way, or the Fed funds rate. You can see interesting time right here when COVID-19 first hit. You can see rates were already pretty low, but they lowered them almost down to zero, and they stayed there for about a year and a half. And now in 2022, with inflation at over 8%, they've begun to really dramatically increase rates over the last couple of months. Now, LIBOR historically is what's been used to base a lot of financial products or loans, particularly business-to-business loans, off of. LIBOR is the London Interbank Overnight Exchange Rate. And really the way that this is determined is a survey would be done to the major banks, and they would say, hey, what are you charging another bank to borrow money on an overnight basis? The banker would give their answer, then they'd average 10 or 15 of them together, and that would determine the LIBOR rates. And a lot of commercial loans are based off of this, or a lot of adjustable rate loans. So let's say that you take out a mortgage, and it's an adjustable rate mortgage, and your rate is LIBOR plus 5, for example. So you'll pay 5 points no matter what. Then in addition to that, you'll pay whatever the current LIBOR rate is. So let's say you had that loan right now. The 1 month LIBOR is at about 2%. This is in October, so it's about 2%. So your rate right now would be the 5 points plus the LIBOR, which is 2. So your total interest expense would be 7% right now on a loan based on LIBOR. I know some of the direct lending and private credit funds we use are based off of LIBOR, which is nice to the investor because it makes the investment non-interest rate sensitive. Usually those are more in the range of LIBOR plus 6, LIBOR plus 7. So of course, if LIBOR goes up, the return to the investor is better, and the expense to the business to maintain that loan is a little bit higher. Unfortunately, LIBOR is being phased out, has been for several years, because it was such an easy process of just surveying bankers with a verbal of this is what our rates are. Of course, it was manipulated a little bit by bankers and banks who had outstanding loans, and they would manipulate the LIBOR rates in order to favor that outstanding loan that they had. So what they've switched to is SOFR, which is the secured overnight financing rate. So very, very similar to LIBOR, and this moves in relation, of course, to the federal funds rate. You can see right here, almost went down to 0 as well, and has ticked up more recently, along with the Fed funds rate. Very, very close correlation there. But this, instead of just being a survey to bankers saying, hey, what are you charging right now? This is actually based off of real data and real loans that have been made from bank to bank in the most recent days. Now, the reason banks have to borrow money from other banks is because the Federal Reserve, in order to prevent the old run on the banks, requires banks to keep a certain amount of money in reserve. So in addition to that, they may be short on funds that they need to borrow or invest or pay back a loan. So they will borrow from other banks on a very short-term basis. And the SOFR is the rate that they pay to be able to do that. Now, probably a little bit more common, especially in the retail consumer side, is the prime rate. So prime rate, which I have right here, this FRAD, bank prime rate charges. Prime rate is what commercial banks charge their most credit-worthy consumers to borrow money. So you've heard of a prime rate mortgage, which is really the best rate that you're going to get if you have excellent credit and a great history, low debt. You may be able to borrow money at prime rate, which you can see right now is at about 5.5. You've heard quite a bit about mortgage rates going up to slow down the housing market. You can see we're at about 3.25 just a couple months ago, and now we're at 5.5. Also, of course, you have subprime mortgages, which were the big problem back in 2008. That means the consumer had less than stellar credit, so they would lend at rates over what the prime rate is. So let's say a subprime mortgage today may be 7 or 8%, whereas just a couple months ago, a subprime mortgage may be 4.5%. Also, a lot of financial and insurance products are tied to prime rates. So again, going kind of back to the adjustable rate mortgage, you may have a adjustable rate mortgage at prime plus 2, for example, or prime plus 1. So your payment is going to change based on where the interest rates are. So if you'd like to know anything, more information about interest rates, or kind of where we as a firm at Neil Jesani Wealth Management think interest rates are going to be going in the next year, to really plan for your investments going forward, certainly reach out to me. My name is Andrew Constantinidis, and my number is 954-800-8552. Thanks, everyone.